You're listening to Real Talk Texas with local expert Steve Hakes. Now, here's Steve.
Welcome back. Today in the studio, we're talking about SBA loans and about small business and how small business has an opportunity to grow by connecting with affiliated bank. And we've got Colin Beal and Gary Graham in the studio today. And we've been talking about, specifically, before the break, we were talking about franchises and things like that. Colin, what are the other things that I wanted to talk about is, let's just say I do decide that I want to go down that road. I'm looking at a franchise and I want to buy one. How long does it take? How much do I need to disclose about myself? What's the process?
Right. Well, Steve, the process is I like to carve it up into about 3 parts. The first part is the application process. And the best thing the borrower can do, or the prospective business owner, is be prepared. And by that, I mean having a basic package of your tax returns, whether that's business and personal, financial statements, a business plan. If it's a franchise, maybe the information related to that franchise before you approach the bank. Those are the basic things that anybody's going to need to begin to look at that loan application. And the more you have available, the easier and faster you will find the process, and probably the more receptive the bank will be to you. The time frames involved vary. Typically, it's going to take about 60 to 90 days to go through the SBA process. A little bit longer if there's real estate involved in the transaction, because we have to do things like appraisals and environmental reports that add time to the process. But that's a good guideline. When you go into the process, it's not an overnight process. It's the bank has to do its due diligence, and then once the bank has approved the loan can go to SBA for their approval. They typically take about 2 weeks to issue an approval. And then once we get that, we can move the loan into the closing process. That will vary anywhere from a week to 2 or 3 weeks, just depending on what we're doing. Again, real estate takes a little more time because of the documentation that's involved in it. Okay. But it's a straightforward process. The best thing I tell people is be prepared. Do your homework before you come to the bank, and you will find the experience a lot easier to go through.
I would think there's a lot of business owners out there that start off and they don't buy property initially. Maybe they lease it. And so I guess what I hear you saying is that if I'm a business owner and I'm leasing property right now and my lease comes up in 6 months, I should probably try to find a property and put a contract on it and put maybe a 4-month contract on it to close. Is that the advice you give your people when they're looking to get out of renting and going into buying if it's a different space?
Right. You definitely want to build some lead time in there, because there is going to be some time involved in securing the financing. Even on a non-SBA loan, it's going to take 30 to 60 days to get that financing put in place. So there really isn't much time difference to do an SBA. The real difference in there is the amount of time it spends at the SBA. Otherwise, the process is virtually identical.
So it goes off for a secondary approval, and so you have to allow for that, and you're not in control of that piece of it.
That's correct.
Okay, so that could take 2 weeks and maybe even 30 days if they got slammed. I know with USDA loans, we have to do that on residential. We have to send it off to USDA, and sometimes those guys get really behind if they get busy.
They do, and there are times in the year where SBA will be busier than other times, typically around year-end, which for the government is September 30th. They will be busier as people are trying to get their applications in. Sometimes during the holidays, there's a rush for things to get done prior to year end for things that need to close in a certain calendar year.
Well, let me ask you this. So I'm renting and I'm getting ready to move my business. And most of the time you wouldn't want to move too far out of your market in some retail situations. But, one of the things that I think my first question would be, how much of a down payment do I need on just real estate? If I wasn't doing equipment or operating capital or anything, I didn't need any of that. I just need to move from renting to buying.
Right. Well, most lenders will require a minimum down payment of at least 10%. I would look more in the 20% range as a general rule of thumb, and it's really based on the individual transaction. We have a lot of flexibility there. SBA does not set any guidelines. That's up to the lender to make that determination as to what they're comfortable with. So typically the stronger the business, the better the cash flow, the less down payment we're comfortable with.
Well, and I think and that's where SBA comes in with the help, is that you can put a little less down, because I think most traditional, say, for example, office loans, they're wanting 25 to 30% down, depending on the size of the deal and things like that.
Right.
It's the typical bank, or even the CMBS market, which is the larger transactions, or insurance-based loans. They typically require 30% down on an office space, sometimes even 35 to do a non-recourse.
Right, and one of the key differences in SBA is they call themselves a cash flow lender, which means we look at the cash flow or the repayment ability first, and we actually look at the value of the collateral last in the SBA world. In the conventional world, they look at the value of the collateral first, which is why they want a bigger down payment, because at the end of the day, if the loan were to go bad and the bank repossess that collateral, they want to have a security or a safety margin in that collateral in case they need to liquidate it. The SBA gives us that margin and allows the borrower to put less down payment in it. And so we don't necessarily look at the collateral value the same way a conventional lender would.
Well, and let's talk about that too. Most business owners set up their business as a limited partnership or an LLC, and that's to protect themselves personally and their family. With an SBA loan, are they personally guaranteeing that loan, or is that going to be?
They are.
How's that work?
SBA requires anyone who is a 20% or greater owner of the business to provide a personal guarantee, and they are not flexible on that rule at all. So if you own 20% or more, you are required to provide a personal guarantee. And in some cases, people who own less than that may be required to provide a guarantee as well if they are what's considered key employees of that business.
The SBA is very structured on what they want in documentation. They'll be generous and open to a lot of loan types, but they are sticklers on what they want in documentation.
That's correct.
Well, let's talk about, what are the costs involved in loan terms. Let's just say I'm going to go, let's walk down that road, or maybe better yet, you can give me an example of what we've been talking about, where you've had a client that's maybe they've had an established business and they're moving into a new building, or how have you helped people?
A lot of things come up. Gary mentioned some clients we're working with right now. One situation we have right now, it's about a 45-year-old company. The business has been up and down the last few years with the economy, but really turning around and coming back up. So we're doing a loan to refinance a number of their debts, improve their cash flow. We're going to buy out a partner in the company who wants out of the business. That's something we couldn't typically do on a a conventional basis. So that partner is going to be out of the business. The company's going to generate some cash flow improvements and buy some new equipment. We roll all that into one long-term loan over a 25-year amortization. And the benefit to them is that cash flow improvement. And that's a loan that would be very difficult to do on a conventional basis.
Well, and it'd be probably a strain on the business if partners are splitting up and one partner wanted his chunk of money out or her chunk of money out at that point. It'd probably be a burden on the business as well, right?
That would, and the business doesn't have the cash available to buy out that partner, so this is a way for them to do that. Some of the other things we do that I've helped a number of folks acquire a business where they go in and they want to buy an existing business, whether that's a new business to them or maybe in addition to a business they already have. Those are loans that we do a lot of in SBA. And frequently those businesses are service businesses that don't have a lot of collateral, but they have great cash flow. And those are great candidates for SBA lending.
Well, I know a mortgage guy that was pretty high up in one of the companies that I dealt with. And he came to me and he said, well, this is the last convention you'll see me at. He just bought a restaurant franchise, and he owns a couple here in town. And I thought, how do you look at a guy he's just been doing mortgages all the time, and now he's going to go set up a restaurant that's a franchise, that's a successful franchise? Maybe it's because of the franchise strength rather than him being
right.
an owner-operator of that business.
In those cases, we do look a lot at the success of the franchise. We look at what kind of training and support they provide the business owner. And we also look to that individual to see what kind of general business experience they have and see if they have anything that translates into that type of business. Restaurants are a great example because most banks will not loan on restaurants without the SBA. Some banks won't loan on restaurants in any case because it's a very risky business. As most of you seen, many restaurants open and close almost overnight. And so it's very hard for banks to become comfortable with that type of loan without the SBA.
Well, let's talk about that for a second. In the SBA world, type of businesses do not qualify.
Well, the types of businesses that don't qualify are based really in two areas. One, not-for-profit businesses don't qualify, and anything that's of a speculative or passive nature. So things like businesses that would invest in rental homes or apartment complexes where they would turn around and rent those out and generate income that way, those don't qualify under SBA rules because that's considered a speculative venture. So it's got to be an owner-occupied for-profit business. And 99% of so businesses out there will qualify for that.
Because I get that question a lot being in the mortgage business, and we've had people on our show here that do house flipping and things like that, and they're always looking for a line of credit that they can go buy houses, flip them, fix them, flip them, and all that, which is a real popular thing right now, especially with all the TV shows out there. You're listening to Real Talk Texas on News and Information 570 KLIF. I'm your host, Steve Hakes, and we've got in the studio today, we've got Colin Beal and Gary Graham of Affiliated Bank, and we're talking about business and small business in America and how Affiliated Bank is here to help them grow their business. So stay tuned.